Live from Singapore, this is Insight with me, Haslinda Amin, a show where we dive deeper into the stories that matter with crucial context and sharp analysis. A victim of its own success, Nvidia delivers a good earnings report, but investors were looking for more after 2 years of blowout numbers. Top tech analyst Munster will be joining us to crunch the numbers and tell us if he thinks the chip maker and its magnificent 7 peers will win back investors again soon. The Indian stock market has also been underperforming compared to its Asian peers. Franklin Templeton's India president will give us his outlook. And from the boardroom to the courtroom, a power struggle at city developments between the patriarch and his son. It's sending Singapore's richest family into chaos, putting an $18 billion business empire at risk. Good, but not great. That appears to be the reaction to Nvidia's earnings. Investors have become used to blowout results, and the latest numbers have drawn a muted response. Avril Hong is here with more. And Avril, when expectations are so high, you can only imagine there will be disappointment.
I mean, we always call it the blessing and curse of being an A-star student, right? So that's exactly, I think, what's been playing out in terms of the share reaction. But let's rake through what we're seeing in the Asia chip makers first. These are, of course, Nvidia suppliers, Samsung Electronics, SK Hynix, TSMC. Clearly, what used to be that boost from Nvidia for them is not materializing today. And we're seeing also, when you look at some of the reaction, perhaps, on the US-China tech decoupling narrative, when SMIC earlier in the session rose 4%, does make you wonder, does that feed into that narrative? Now, let's flip the board and take a closer look as well at the reaction after the earnings result, because we saw Nvidia fluctuating and then trading quite negative. Clearly here, this is not just an issue for the company, but also for US stocks overall, because you know how they've been riding on this idea that, you know, there's a lot of AI enthusiasm and the idea that there's pretty much not much else to invest in when it comes to stocks. So that's what they've been riding on. And if you look at this chart, it shows you how US stock exceptionalism has been fading. You compare it to how Asia has been tracking Europe in terms of decoupling with US stock performance. Flip the board again. Let's take a closer look at the Nvidia results. It was a beat for revenue, it was a beat for forecasts, but as you alluded to, the magnitudes of the beat pale in comparison to what investors have become accustomed to. The other issue is also on the margins. When you look at how they have to get to the projected levels, that would entail a lot of catch-up in the second half. Maybe even with the CFO saying there could be improvements of costs, that investors are not convinced given the tariff uncertainty. Now, we also heard from the CEO, Jensen Huang. He touted the Blackwell chips. Have a listen.
Blackwell is going to be incredible across the board. And when you have a data center that allows you to configure and use your data center based on, are you doing more pre-training now, post-training now, or scaling out your inference, our architecture is fungible and easy to use in all of those different ways.
Jensen Huang sounding very much in sales pitch mode, Has.
Well, that's right. Let's get insights, perspective from our guest today. We have Munster, co-founder and managing partner at Deepwater Asset Management. Deepwater owns Nvidia's stocks. Gene, it was good, just not good enough.
Yeah, I would actually say it was great, but not extraordinary. And that's really what this needs to be. And when you think about extraordinary, you got to beat the whisper on what the raise is. And so the whisper was that they're going to raise by a couple billion. They raised by $1 billion for April. As however you said in the setup, is the margin guidance. They talked about that being a couple percentage below what the street was at, 1% specifically, at 71% versus 72. And when you have a company like this that, of course, expectations are so high, I think in any normal environment would be down. When you talk about margin pressure, I think it's justification for the stock to probably trade lower on the first trading tomorrow morning U.S. time. I expect it probably to be down. My guess is probably around 5% because I think that margin really stung. And it was interesting to look at the stock in the after hours trading. It was up a couple percent up until a few minutes to the last question on the call. And the question was related to tariffs, and specifically is, can you get that ramp in margins? Because I mentioned the negative commentary about April margins. They also said that margins would ramp in the back half of the year, back to the mid 70%. So it goes basically go from 70% to 75%. And can you achieve that with the tariffs situation getting more intense? And the answer was, we don't know. It's a fluid environment, and it's not baked into our guidance. And so you quickly saw the stock drop a couple percent. And it's kind of faded since then. And so what that tells us, that stock reaction, looking at it in the aftermarket, it really gives insight to what investors are thinking. And what they're thinking, the central question they're asking right now is, can these margins ramp in the back half of the year? And I think that was a little bit in question. One more point that's, I think, critical here is that the setup going into this, one of the central questions, a pressure point, which I would describe it as, was what was the backlog? How long would they be sold out of Blackwell in calendar 25? And last quarter, when they talked about calendar 25, they said it would be several quarters that they would be sold out of Blackwell. And a lot of investors were focused on, like, what's going to be the new commentary? Are they going to say that it's sold out for the full year of 25? That kind of was the expectation. But they pulled that language from the CFO letter, and surprisingly, no one asked the question on the call. And I think that kind of the absence of that, I think, is also nagging at investors kind of some of their confidence right now. So I just want to highlight, it sounds like I'm really down on Nvidia, but I just want to highlight that there were some headwinds, but there are also some very positive long-term pieces to it that I think will ultimately, even though the stock trades off tomorrow, cause the stock to move higher over the next year and 2 years.
So, Jean, a lack of clarity on how it might do in the coming quarters and coming years, for that matter, 26, 27. I mean, you alluded to the demand for Blackwell, for instance, how strong it's going to be. What is the sense you're getting? How are you reading into all of that?
Well, I think demand is, they said that it's at all-time highs, but ultimately this concept that we're early and you need hardware to build that, I think that is really important. The other piece is that they talked about the performance difference with Blackwell being 2 to 8x better than anything else, any custom chips. So ultimately, I think that this is still very early in terms of where the demand curve could go. So I think we're still very early. Like, how early are we in AI? We're probably in inning 1 of a 9-inning game at this point.
So given expectations of that 5% drop when Nvidia trades tomorrow, your time, would it be a buying opportunity if you believe in the longer-term story of Nvidia and AI, as you alluded to as well?
Ultimately, it is. And I think the central question is, can they exceed the numbers for calendar 26? That's what this all boils down to. And so the 25 is kind of a throwaway because we just got to get this ramp in the back half of the year. But the street's looking for 23% growth. And that's the question that I think all investors need to ask themselves. From our perspective, we think that they could probably grow 30% or better in calendar 26. And part of that reason is, again, this need for greater compute. And I just want to put a finer point on that. How can they grow faster than that 23%? Jensen did not give that critical update in terms of how the backlog was, where they sold out for this year. But he did say something that the need for compute for these next generation models is going to go up exponentially. And the numbers he gave were so crazy, it's just hard for me to even wrap my head around it. They're so crazy, he almost loses credibility on it. But let me just frame those in. Is that he said when you do a spot prompt, which is something basically asking a generative model a question where you get a quick response back, that the shift from that to reasoning, when it thinks a little bit longer on it, this, of course, is one of the big trends in AI, is the shift from just generative AI to more reasoning AI, is that reasoning piece requires anywhere from 100 times more compute. That's where he started at in the call. And then a minute later, he said it could be thousands, hundreds of thousands, or 1 million times I did go back and check the transcript on this. 1 million times more compute. And what he's saying is the need for this advanced compute to really power reasoning, and then what's considered physical AI and robotics AI is still going to be ramping. And that's ultimately why I think that this is a buy here on the pullback, is that if in fact we are going to see several levels of increase in the compute, they're going to have a great business for the next several years.
There is a risk, though, here, Jean. You talk about the next several years. The risk is, of course, Trump tariffs and that chip war between the U.S. and China. We know that Nvidia has been caught in those crosshairs. And Jensen Huang himself said it is too early to tell how it will be impacted. How do you think it will be impacted?
So right now, they didn't break it out. It comes out, and when they put the Q out, or the K comes out, we'll know what the exact China, but it's probably somewhere around 13–15% of revenue. And so they did say on the call that if not for the tariffs, it would be 2x. They also said that the current chips that they're selling to China, that they're able to, with these export rules, are about 60 times less powerful, the ability to generate tokens, 60 times less powerful than the GB200, which is kind of their premium chip. And the reason why that's important is that essentially the China opportunity for them is really stalled out. And the chips that they're selling really aren't adequate to what China wants to try to advance AI. And so I think that's part of the reason why you see such a strong Singapore number. Singapore is over 20% of their revenue. And so the way we think about, to answer your question, is like, what does this whole China thing mean to it? Is that as it stands today, status quo is that it's factored into how investors and analysts are thinking about the business. But if in fact the restrictions get tighter and they can't even sell some of these less advanced chips, if that ends up happening, you could see further pressure on margins and further pressure on some of the growth rates. So it is, again, that's what caused it to move in the aftermarket down lower. I think that this was kind of a surprising topic that emerged from the conference call, and it's something that Nvidia investors are going to be watching a lot over the next few months.
As it stands now, we know that Chinese players are waiting for about a year for that supply of Nvidia chips, and that's prompting Xi Jinping to say, you know what, forget about the wait, rely on your own domestic players. I mean, you got to wonder what the impact would be on Nvidia on the back of that, especially since we saw DeepSeek and how that's changing the landscape in China.
Yeah, and at the end of the day, I think the reality is that Nvidia has the best chips in the world. And if you want to train the most advanced models in the world, you need Nvidia chips. And so when I think about this concept, this call for a different class of chips, whether it's custom silicon or some AMD competitor to Nvidia that could address that appetite in China, I just think it's a low probability that something's going to emerge in the next 1 or 2 years. And as far as DeepSeek, it of course came up on the call. One piece on DeepSeek is that DeepSeek did a great job of really having that second tier model. But most of the value creation around AI is going to be having the most advanced models, because no one's going to want, I mean, consumers may want a cheaper, less advanced model, but most of the substance that's going to be able to pay for AI is going to want that most advanced. And I think it's going to be extremely difficult to really get to that artificial general intelligence, that most advanced AI, without the help of Nvidia chips for the next several years. And I think that's a reality. I don't know how China ends up navigating that reality, but I think it's just a reality of the market and a benefit that Nvidia is going to have, why their business can continue to be healthy for the next several years.
Jean, we know that Deepwater owns Nvidia. You don't personally own it. Why not? And linked to that, what would it take for you to personally own Nvidia?
Well, the reason why I don't own it is we have, for compliance purposes, we can only own a couple stocks. The 2 stocks that I own are Apple and Tesla. It's not an indictment against Nvidia. It's just we've got a roster of 2 stocks, and I'm even though despite Tesla's recent backwards moved 30% down, I'm still optimistic there. But that's the reason why.
Let's talk about Tesla then. We talked about how Elon Musk had been quite a divisive figure in the global political scene. I'm just wondering how you're assessing his impact on how Tesla stocks have been moving of late.
So what we've seen, what's going on right now is the street is basically coming to grips with what the real outlook is for deliveries in calendar 25. And if we rewind 3 months ago, Elon talked about delivery growth of 20 to 30%. And then he didn't talk about that when they reported their December quarter, so a few weeks ago. And then analysts kind of settled in at about 12%. That's the current in-print numbers for Tesla, is 12% delivery growth for calendar 25. But as you look at what some of the registration numbers that recently came out of Europe a couple days ago, and I think you look at what the sense is about where Elon is just, his brand right now is alienating some of their customers. I think that is having an impact. And so the point of this is that probably the real numbers are somewhere around 1.7 or 1.8 million deliveries, which would probably be down. If it's 1.7, it's going to be down about 5% versus calendar 24. But that adjustment, when you have an expensive stock, and as an investor, you get concerned about how the stock is going to react as estimates are going down. And what I think is going to happen is before they report their quarter, maybe even before the delivery numbers come out for the quarter, I suspect that analysts are going to start lowering their numbers. And that's probably when the stock bottoms, is when that just kind of gets fully flushed out. But that's, I think, the big factor. Remarkable how quickly the focus for investors shifted for all things autonomy in the long term to the near term and what deliveries are going to be for 25. And that speed that it switches to the negative, it can equally switch back to the positive around some comments around what's going on with their autonomy fleet, the Cybercab, Optimus Prime. And so I think we're going to see a turnaround once the numbers kind of get readjusted. Still believe this is one of the most exciting companies when it comes to AI.
But the thing is, there's something to be said about brand loyalty, especially when it comes to cars. And detractors have come out to say that, you know what, they're taking it out on Tesla. What's the risk that you put, on Elon Musk when it comes to playing the Tesla story?
Well, the risk to what he's doing to the impact to the story is, I think that part of the reason why, we're talking about the in-print numbers a few weeks ago being plus 12%, and I'm suggesting that they're going to navigate, they'll kind of settle out at around flat to down 5% year over year. And I think one of the biggest X factors is just his focus, I think, on politics, and that can alienate some potential buyers. I'm looking at the European data, and that's why I'm focusing on that. In the U.S., there's a dynamic around the electric trade, the electric halo has faded. And I think that there is a kind of this sense of going back to traditional sources of energy, which may be having a little bit of an impact, negative impact. So I think the political environment, the bottom line is the political environment for those two reasons is having an impact on Tesla. The good news is that I believe it's an undeniable truth that all cars will be electric. I think it's not about the environment. There's benefits to it, but that's not why I believe that. I believe it's just fundamentally a better way for energy to move things around. And ultimately, I think that that's why electric cars are going to continue to do well. And keep in mind, they're going to have some new cars coming.
Gene, final question. Mag 7, still the way to go? Given where valuations are right now, some people are suggesting perhaps the Chinese version of the Mag 7, the likes of, Baidu and Tencent, may be the way to go from here.
So I think that the performance is going to come from smaller companies, sub 500 billion. We refer to that as frontier tech companies. And so I think the Mag 7 is still going to do well. I think investors should still own them. I think they're going to appreciate this year. I think we're still going to have 2 great years of the market. It will end in a spectacular bubble bursting in a couple of years, but we still have a couple of great years to go. I think the Mag 7 is going to benefit. But I think you're going to see more upside from some of these smaller, if you call it 500 billion in market cap and smaller companies. And so that's where our focus is, on shifting some of the portfolio, maintaining some Mag 7 exposure, but shifting to more of these smaller companies.
Stay the course. Jean, thank you. Jean Munster, Deepwater Asset Management. We thank you so much for your insights today. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. President Trump has given a series of apparently contradictory answers about his tariff plans. During a cabinet meeting, he was asked if he would move forward on levies against Canada and Mexico next month.
Mr. President, can you clarify the Canada-Mexico tariffs? You had put that 30-day pause, but you just referred to April.
25%.
25%. When does it go into effect?
April 2nd.
April 2nd for Canada-Mexico.
Correct. And for everything.
The White House later clarified that the deadline for those tariffs remains March 4th. Bloomberg senior editor Bill Ferris is here with us. You know, if you've been paying attention to what Trump has been saying, you would be confused.
Absolutely. I mean, March 4th is literally Monday. So it's a huge deadline looming over the U.S. and U.S. markets and U.S. importers in terms of, whether these 25% tariffs come into effect. We've heard of no deal officially with Mexico and Canada to extend that deadline by another month. So I think there is a lot of confusion coming out of that meeting at the White House, what President Trump meant and what is actually going to happen within 72, 96 hours from now.
But whatever the date is, it's going to be 25% tariffs for just about everything for Canada.
Yeah, he seems to be sticking with that number. We haven't heard of any changes to that at all, and it's across the board. So really kind of eviscerating the U.S., Canada, Mexico free trade agreement. But whether that comes into effect, we saw last time it was the day before, I think, before they were initially expected to come into effect, that we got that 1 month reprieve. This really opens up the question of whether there's going to be another reprieve that might extend it into April.
And of course, it's just about everything. And when it comes to that, it's also, the impact will be in Mexico as well.
Absolutely. This is going to be a big hit to both Mexico and Canada. But as especially Prime Minister Trudeau in Canada said, he looked at, I think, 35 states have Canada as their top trading partner. So it's a huge impact across a number of the U.S. state economies. But the big question is, will it happen? 96 hours to go. We still don't know.
We await, as we usually do. Wait for the headlines, Bill. Bloomberg senior editor Bill Ferris there. Well, still to come on the show, the Indian stock market has been underperforming compared to its Asian peers. Franklin Templeton, India President Avinash Satwalekar will be joining us with his insights on the challenges as well as the opportunities. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. Indian markets are coming back online after a holiday with the startup trading in just a few minutes. The pause was a welcome one for the Nifty, mired in a 6-day losing streak, down almost 5% so far this year. Now, that price weakness is helping to ease some of the valuation concerns keeping investors away. The Nifty's valuation premium over emerging market peers is down to almost a 2-year low. We're also keeping an eye on the rupee, which tumbled the most in 3 weeks before the holiday. President Trump's barrage of tariff threats and India's tricky trade relationship with the U.S. hitting risk sentiment. Joining us exclusively now is Avinash Satwalekar, president at Franklin Templeton, India. Avinash, good to have you with us. You know, the uncertainties remain. Growth is in question. It just looks more attractive elsewhere, like the U.S., like China. You can only imagine that the pressure on Indian stocks will continue from here.
Well, firstly, good morning and thanks for having me. Well, I can't deny the fact that the markets have been under pressure. We're off about, like you said, 5% year to date. Having said that, a lot of the reasons why that pressure has come through is mainly because of a slowing down in the GDP growth rate. So we expect that to actually start to ramp up in the next couple of quarters, along with earnings growth, which, as you know, drives the capital markets. The other thing you brought up was actually the relative attractiveness of India. Now, that, in my mind, is continued to be attractive, especially if you've got a longer-term view. I don't think there's a single large market that has a 6-7% growth rate, and that is likely to be the third largest economy in the next few years.
So you talk about the Indian markets moving in tandem with Indian growth. Are you looking at India's growth story getting back to the 8% that we saw before, or hovering at 6 to 7%? Will that be enough to actually lure investors back to the Indian market?
So I think the 7 to 8% growth rate, is it possible? It's definitely possible. It's going to require a significant amount of change in terms of infrastructure investment and capital investment from the private sector. Having said that, the 6 to 7% itself, in my mind, is very sustainable and is likely to stay in place. And that should be pretty attractive, as you talked about valuations coming down. When I look at relative growth rates and relative valuation, India still stacks up extremely well.
Is it coincidental that we're seeing the sell-off in the Indian market at a time when we're seeing a rally of Chinese stocks, especially those trading in Hong Kong?
As you know, nothing is coincidental, right? I mean, there's always a play for relative capital, right? Now, if I look at valuations, the Chinese equities definitely have been at a lower end of their valuation curve compared to the Indian valuations, right? So there's always a draw towards that. And if you see a promise of slightly improvement in the economy, you're going to see capital shifts. Having said that, right, if I look at longer term, like if you're looking out 3 to 5 years, I think the sustainability of growth rate, the policy stability, the political stability, all of that plays to India's favor. And there's a tremendous amount of internal growth that is still way ahead of the markets. So in my mind, I think you're right. There is a relative game, but I think India has that strength in terms of relativity just by virtue of its growth rate, right? I mean, we're in multiples higher than any other large economy. So I do think that that will continue to sustain itself.
You talked about how capital is shifting, and it does seem like capital is shifting according to what Trump is saying, Trump tariffs in particular, and we're looking at reciprocal tariffs when it comes to U.S. and China. So far, concessions already made by Prime Minister Modi have done very little to actually move Trump in any way. I'm just wondering what the risks are when it comes to the threats of Trump tariffs.
So the Trump tariffs, as you put it, are definitely, I mean, there's a very clear agenda from the U.S. president that there is going to be a control around tariffs. Having said that, the government has been very proactive. They've actually gone out and had discussions, tried to get more of the bilateral agreements in place. So I think that is going to be less of an issue. Now, are there policy decisions that are going to be made that make it even more attractive for U.S. businesses to start investing in India? The answer is most likely yes. So if you look at India's relationship with the U.S. when it comes to kind of trade, Number one is going to be a focus on expanding the bilateral trade agreements, expanding the bilateral investments across. Second, it's going to be around defense investments, right? So the Indian government buying more defense equipment from the US. And lastly, it's going to be around energy purchases as well. So that's going to be kind of the trifecta, if you look at it, from an investment perspective that will improve the relationships and obviously alleviate the pressure that is likely to come from tariffs.
So how is that shaping your asset allocation, your sector allocation?
So I think none of this really dramatically changes because, as you know, we'll focus on the long term. In the long term, we are really focused on consumption. How it does affect it to a certain extent is we do want to spend more time looking at infrastructure, trying to drive some of that additionally, because that will be a big purchase. Then there is obviously the shift in terms of energy itself and how do you look at difference in terms of renewable energies versus fossil fuels and that whole transition. And that takes an entire system to change. And I think that's where we're going to see some expansion. So does it change our focus in terms of where we're spending our time? Not to a great extent. We are looking at consumption stories because, as you know, at 1.4 billion people, that is a massive opportunity. That population is also getting a lot more wealthier. So in the most recent budget, if you saw, the tax rates for the bottom segment has been dropped. So anybody under that earns an income under $15,000 per year is no longer being taxed. And that is a significant boost for the consumption story. I think there's a technology shift that's occurring as well, and that's a transformation that's occurring everywhere, right? And you're starting to see a lot of that play through. And so we are very focused on trying to invest in that theme itself. So longer term, none of this really would change it. In the short term, obviously, you're going to have to manage it out. But valuations the way they are today have definitely helped take away a ton of that risk.
If you have yet to be exposed to the Indian consumption story, how best to position for that? What is best for you to own right now?
Well, so, we don't necessarily talk about names in particular, but I would say anything that looks directly at consumption. And what I'd also draw attention to is look not just for kind of the premiumization. You're looking for things that are actually in the broader segment, the middle segment of that market, because that market is expanding just from a demographic perspective as well. So that's where a lot of activity is likely to happen.
We talk about the opportunities in the Indian market. I mean, you talk about the consumption story, 1 billion people, it's hard to miss that. There are also risks involved in that. You talk about consumption, we've seen how that's been a slowdown, not just in the urban area, but the rural areas as well. Talk to us about the risks when it comes to investing in the Indian market.
So there's definite risks into investing in any market, right? I would say a lot of the risks that are in the Indian market are more driven by what is likely to happen outside of India rather than what is happening in India, right? Now, within that context, so where do we look at what are the main risks we're worried about? We're looking at geopolitical uncertainty. Now, when you see geopolitical uncertainty, what does that translate to? That translates into a higher oil price, which does have an impact because India is still an economy that drives a lot from oil consumption, right? So that has an impact. Now, having said that, I think whether it's the dollar strengthening as a potential risk, because obviously that hurts on the internal import side and it creates inflation, that to me are some of the risks. But your point particularly about is there a consumption risk and the rural versus the urban issue? I would say that this budget has really focused on helping that rural economy. Now, it does take a couple of quarters for any policy to start having an impact on the economy, but that's precisely what is being done. It is being addressed, and that should alleviate it, which is why I go back to kind of looking at that consumption at the middle segment of the market.
We talk about the risk of that mighty dollar On the back of that, we have a rupee that's been hovering at record lows, if not at record lows. How are you assessing the weakness in the currency? It obviously, some say, doesn't reflect the fundamentals of the economy. And linked to that, where do you see it trading?
So currency itself is a reflection of, obviously, the strength of the economy or the relative strength of the economy, right? Now, if you look at historically, and I'm talking about a 20, 30-year history, the currency has, on average, done anywhere between 3 to 5% in terms of depreciation, right? It does go stair-step. So, I mean, I think if you can see the chart right there, there are stair-step moves. But if you average it out, if you smoothen it out, it is anywhere from 3 to 5%. There is an element, excuse me, of how you look at the impact of that. Inflation has definitely been a factor in there. In my mind, quite honestly, you factor that into your assumptions when you're investing, when you're starting to look at future prospects, right? So I don't necessarily think that the currency, it's a result of what happens with the economy. It isn't something that you can plan off and say, okay, I can make an assumption that I think we're going to be at whatever, 87 or 90 or 85, but can I really change my investment decisions? And are those really going to drive the longer term? Probably not.
Avinash, talk to us about your AIF fund. Where are you with that? What's the latest? Where are you seeing the strongest interest?
So the AIF fund is, it's the Alternative Investment Fund. We are in the process of kind of launching that. I'd say there is a ton of interest because, as you know, private credit has a ton of potential in India. There has been interest, but as I said, we are in the process of going through there. So the interest has been positive, and we're likely to kind of get through that, I would say, in the next couple of months.
Are there other strategies, opportunities you're looking at in the next couple of months as well, or in the next 12 months for that matter?
So I tell you, a lot of what we've been looking at, we have a fairly wide basket of equity offerings already. On the fixed income side is where we're starting to expand. And if we look at where we think rates are moving and where rates are currently, we've tried to expand out the number of offerings that we have at the longer end of the curve. So we're looking at a lot more on the duration plays. Having said that, the steepness of the curve hasn't really changed dramatically. And so we're actually looking at essentially being able to play in any part of the duration curve. So where will we see additional product sets coming through? It's more likely to be in the mid-long term that we've already kind of launched, and then it's at the short term. So it's pretty much across the board. And part of that is because of what we expect to see in terms of interest rate movements. And I think we've already seen one cut out of the central bank. We're expecting to see another cut in the next 3 to 6 months, and that will help that longer duration story.
And of course, you have to bear in mind the higher for longer that the Fed is likely to adopt in the U.S. How might that play out? What might that mean for the RBI?
So I think the RBI has a pretty solid lock on what's going on with the Indian economy. And a lot of its decisions are driven by what is going on with the Indian economy. So if you see RBI cutting rates right now is clearly a response to a slightly mellowing out of the growth rates. Now, with the Fed staying higher for longer, now obviously that also is a question mark whether it is actually going to be able to hold that through. If it does do that, I don't think it necessarily changes RBI's decision in terms of how it is going to do, what it will do to support the Indian economy.
Avinash, thank you so much for your time today. Avinash Satwalekar, President at Franklin Templeton, India. Now, oil prices near the lowest close this year due to tariff threats from U.S. President Donald Trump and supply issues. The brewing trade wars between the U.S. and its trading partners cloud the economic outlook. That anxiety has eclipsed the possible sentiment boost for oil from tighter sanctions against Iran. As traders weigh rising risks from geopolitical tensions, we're keeping an eye on Taiwan. President Trump has declined to comment when asked whether it was the policy of his administration to prevent China from taking control of Taiwan by force. It comes as China's fourth-ranking official, Wang Huning, unveiled stronger language toward Taiwan, calling on the nation to shape their inevitable reunification. It is the first time that phrase had been used by the government in Beijing. Now, this week, we're looking into Taiwan's emerging drone industry. Bloomberg traveled to Chiayi County in the south of the island to visit a major R&D center. We spoke exclusively to the region's head, Chang-Liang, about the interest they're seeing.
The entire drone industry, particularly in the non-red supply chain, is currently under strict regulation in Taiwan. So manufacturing should still be primarily concentrated within Taiwan. Taiwan now can produce 90% of the components in a drone. This means that we will still have issues in the supply chain, and securing components from so-called democratic supply chain comes at a much higher cost, as production is not done on a large scale, but rather through customization. This is the core difficulty we face. Our most critical breakthrough will be figuring out how to open the market and establish organic connections with the global democratic supply chain. This is our main focus moving forward. For example, in the past, an engine manufactured in China might have cost only 10,000 Taiwan dollars. However, if we were to produce the same customized engine in Taiwan, the cost would rise to around 60,000 Taiwan dollars. This stark cost difference is a challenge we must address. The key to reducing manufacturing costs lies in expanding both the supply chain and the market.
Do you think it's ever possible for Taiwan to be able to produce a drone for the same price that you can source from China?
China's drones hold a 70% share of the global market. Taiwan's strengths lie in its abundance of ICT talent. And Taiwan produces the chips that the world desires. Taiwan also has a wealth of expertise on materials science. Therefore, I believe our approach should differ from China's mass-market, low-cost drone production. Instead, we should focus on developing high-end and specialized drones, rather than models for general consumers.
Bloomberg's Annabelle Drewer is speaking exclusively with Chang-Liang, magistrate of Chiayi County in Taiwan. Now, still to come, a real-life succession drama looks to be playing out in the boardroom of city developments. This is Singapore's biggest listed developer. The details of the dispute next. Keep it here with us. This is Bloomberg. Well, we're taking it back home. Singapore's Kwek dynasty is engulfed in a father-son succession drama, the latest family feud to erupt in one of Asia's family empires. Kwek Ling-beng, the billionaire chairman of City Developments, is suing his son Sherman as the pair tussle over control of Singapore's biggest listed developer. For more, let's bring in Bloomberg Singapore real estate reporter Dexter Low and our very own Avril Hong. Avril, let's start with you. Tell us more about this lawsuit. It's come as a surprise somewhat.
Yeah, and it's a really stunning turn of events because this lawsuit was pretty much announced on the day where the earnings results were in. So I think it's fair to say it took the management but investors by surprise as well, and they had to cancel the press briefing for post-earnings. Trading in the stock was halted, still is halted. Essentially, this lawsuit is being brought on by Kwek Ling-beng, the 84-year-old chairman of Hong Leong and CDL, and along with a number of these board members and CDL, it's being brought against his son, Sherman Kwek, and a number of directors. And essentially, they are alleging a serious lapse in corporate governance, and it centers around the appointment of two directors to the board earlier. And they think that this kind of circumvented the normal nomination process. So to their point about, they're arguing that this was a corporate governance lapse, maybe they also think that this was part of efforts to consolidate power. So the lawsuit on Kwek Bing's part is to kind of right the ship, set things right. We've also heard from Chairman Kwek. In response to this, they released a statement and said, they're incredibly disappointed by these extreme actions. Those were his words, and it really shows you the tensions between the older and the younger generation that might have been simmering under the surface for a long time. Now they're bubbling over into a public feud, Huss.
Dexter, give us some color. Was it something that was going to happen eventually? We didn't hear any murmurings from the get-go. I mean, this was a surprise. So what happened?
I think even people within the company are surprised. To give you an extent of how close the two families are, or rather the father and son is, they have basically stood by each other for the best part of Chairman's tenure when he took over as CEO in 2018. And I think one of the issues that was quite revealing in the very long letter yesterday where Kwek Bing basically blasted his son is he talked about some of the disasters or what he called problems that has arisen during Chairman's tenure since he took over as CEO. But his father has always stayed as a chairman, and he's considered one of Singapore's most successful real estate developers, billionaires, and his record is very long and very impressive, of course. And this is a guy who famously went head-to-head with Donald Trump in a very famous deal in the 1970s, and he actually got one up on Donald Trump. So I think the problem for Sherman has been that both in the markets, but as well within the family, there has been a sense that he has always been in the shadow of his father somewhat. Even when he took over as CEO, Kwek Bing really stayed on as chairman. So the question right now for a lot of people is whether or not this is purely a question about corporate governance, or is it a more deep-rooted issue related to questions about Sherman's ability to be as a CEO?
But what was the straw that broke the camel's back? We talk about the issues that have erupted before, but they were never surfaced until now.
So I think one of the main issues that Aaron mentioned is that there's issue of corporate governance. So there's a lot of technical details involved, but the long and short of it is that basically what Kwek Bing alleged is Sherman was trying to consolidate control over the board. There's generally been a feeling that Kwek Bing, the chairman, has always been in control and controls most of the major decisions that city governments do. So, for example, one of the major issues that came out during Sherman's tenure was their failed investment in a Chinese property company known as Sincere. That went very badly for the company. Kwek Bing yesterday called it a debacle that led to 1.9 billion Singapore dollars worth of losses because they had to write down almost the whole investment. When that happened, the family actually ruptured publicly for the first time. One of Kwek Bing's cousins actually left the board at that time. But Kwek Bing has always stood by his son and kind of said that he has runway and really stood by him when there are mistakes of this magnitude.
And investors obviously not happy. We've seen how that's played out in the market. That's all the time we have for a very, very huge story here in the Lion City. Bloomberg Singapore real estate reporter Dexter Low and Avel Hong, thank you so much for those insights. And here's a look at our show tomorrow. Lighthouse Canton Sunil Garg will be joining us to break down a busy week in markets with investors digesting earnings, U.S. economic data, and the latest Trump headlines. This is Bloomberg.